All right, first question of today we have Claude asks, "Hello, this is the first time here that I'm here. I like the simplicity of it, great work and efforts. I got entered into a sell position on GBP NZD. So I'm guessing it's this down here, I think. I don't know what the 0525, I don't know where that is. Maybe up here? All right, so you're in a sell position. Maybe it's up here. To check as an all-time high, to check as it is at an all-time high with the high likelihood of reversing, yet it goes against me. So now should I add another sell or hedge the first sell? And what scenario to expect? So a lot of this will come down into the pre-planning and structuring of the trade before you enter it. If you're asking this question, that tells me that you probably didn't plan it out before you entered. And that's okay because now you know, and now you can do that next time. You can just make sure that you plan before you've entered it. Whenever you are taking any trades at all, does not matter what the scenario is, all-time high, break and retest, it's made a higher high and you think it's going to pull back, make a lower low, whatever the hell the analysis is, you have to select an area at which you're going to manage the trade if it's not working. Typically, if you're using support and resistance, which is why I use support resistance, it makes it very easy to manage this. Typically, if you sell at a resistance zone, maybe like you did, I don't know if you sold at resistance, but you sold for whatever reason. Typically, if price moves right past that area, it gives you a very clear location to say, I'm wrong, let me either close the trade at a loss, let me hedge, or let me maybe close a small position of the loss and then hedge the rest. You can do whatever you want, but a place where you can manage it if it goes against you. Support and resistance makes this very easy to pre-plan because you could just set an alert there, or you can even set a pending hedge order or a stop loss, and then it manages it for you. On the contrary, it becomes a lot more difficult to manage things whenever price is moving up, for example, moves up, makes a high, moves up, makes a higher high or all-time high or something, and then you enter a sell right here. There's two things that go into this. Number one, what are you going to do if it starts going against you? And then how far are you going to let it go in terms of pips before you're going to do something about it? And number two, your position sizing. Now, if you're using a 0.01 standard lot on a $100,000 account, probably really won't matter because it can go as far against you as you really want. You're probably never going to blow that account. Never say never, but you're probably never going to blow the account. But if you're using, say, example, one standard lot, and price starts ripping against you, that can quickly turn into thousands of dollars of loss if it continues ramping up in the uptrend. So the distance at which you are going to do something to manage the trade has to be predetermined before you enter. In this case, let's say that you think price is going to go up 150 pips, and if it does that, then what you'll do is you'll hedge. Another thing you could do, which you already kind of suggested, is you're like, it's at an all-time high, should I add another sell or should I hedge the first sell? That's something that you'll have to pre-plan before the trade. I don't know. If it were my thing, I would probably say I still think it's going to go down at some point. I don't know when it would do that, and I'm not saying you should get net short or sell. I'm just saying usually after a huge run up, price generally has some sort of a pullback. So, I mean, you're free to do whatever you want. But you unfortunately, you're not going to be able to add a sell if your first position was sized inappropriately and too heavily to where adding another sell would dramatically increase the risk and exponentially make the likelihood of your account blowing much higher. So it's something that you'll have to do. What my suggestion, my non-financial advice suggestion would be in this scenario, close the sell trade at a loss if you're not sure what's going to happen and you're not sure what to do, and then never again in the future take another trade unless you've pre-planned what the scenario is. It's okay to think that, all right, price is likely to move from here down here to this previous support resistance zone. So your idea would say to take a sell here and you want to profit on it moving down. There's nothing wrong with that idea, but you have to pre-plan what you're going to do if price moves against you. You can pre-plan it to say, if price moves against me about 100 pips, then I will add another sell. And then at that location, if price does that, maybe you're only in, I don't know, $100 drawdown, $500 drawdown, $1,000 of drawdown. You can use a lot size to where you've appropriately planned for that drawdown if it occurs. And then if it moves another 100 pips against you, you're free to add another position. But again, this has to be pre-planned in the risk structure whenever it comes into the trade management of what you're going to do if you're wrong. And let's say if that third time it pulls back and you just close everything at net break even right there, maybe you hold to the first position, maybe you keep holding and you think the original idea will play out. And then of course there's always the trades where you just enter, and then as soon as you enter, they just go right into profit, and then you can close wherever you think it's going to bounce, usually at the next zone. The reason I prefer, and like I said, there's nothing wrong with this, the reason I prefer support and resistance is because it makes it very, very, very clear as to what is going to happen, such as price is going to bounce at this resistance zone, or it's going to break through the resistance zone and maybe continue to the next zone, or break and retest this zone, or fake out, maybe it comes back, but it's either going to go up or down. Support resistance makes it very clear to make the decisions. When it gets to the next zone, you can close your buy right there thinking it's going to bounce. You can add a sell, and if it comes back and bounces halfway, then you can break even on the sells, having profited on the buy. Or if it breaks up again, then cool. Then what I do is I just close that second sell at a loss, and then I'll just fucking re-hedge the first position. And now you're still sitting in a hedge. You're in this sell and that buy, but you've made a little bit of profit on the way up, and then you have an open loss of this distance and an open loss of this second distance. Actually, no, this is a realized closed loss. But there's multiple ways you can manage it. Here's my suggestion, Cloud, is use support and resistance just to get the feel of things first, just because it makes it very, very clear and simple for how to manage positions. It can become exponentially difficult to manage positions where you don't have a clear support resistance zone. I know you have a red zone here. I'm not sure if I would call that a support resistance zone, just because nowhere recently in the past has price bounced at it. Maybe way back, like you said, in 2016, but yeah, it just becomes hard to manage these trades unless you just use small lot sizing and you just add to the sell positions as it keeps going up. And like I said, you can do that if the position sizing is small enough, because the likelihood of those playing back and pulling back eventually is very high, and you don't really have to time the entry. You do have to use appropriate position sizing though. Let me know if this helps, Claude, and let me know if I can clarify anything for you. Yenis says, "Hi Nick, almost embarrassed myself." Almost embarrassed to ask as I got myself into a stupid hedge. It's okay, Yanis. I still get myself into stupid hedges these days, so I get pretty embarrassed too, very often. So you see, you should have closed with a tighter stop loss. Anyway, any advice would be appreciated. So, Yanis, unfortunately, I don't know a lot of your analysis as to why you took this trade because you didn't explain a lot. However, I'll look at your screenshots. I'll do the best I can to give you some non-financial advice. So let's go ahead and have a look. All right, Yanis, so I am guessing, I'm guessing that the green is your buy, and I'm guessing that the red is the sell. And with that logic, we will then try to give some feedback on this. So you got yourself into a stupid hedge. You should have closed the tighter stop loss. Anyway, I don't really know. Like, this is still at a support zone, it looks like. I don't think it's gonna keep going up. Actually, it looks like it's actually gonna keep going down. You said the second screenshot is the daily. This looks like it's failed to bounce for like a week. I think this is gonna keep going down. So, and also the lower time frame, 1 hour, is still making lower highs. So that would make sense for it to keep going down. So yeah, I mean, you said you should have closed the tighter stop loss. I don't really know what your original criteria for entry was. I don't know what your risk management structure was or anything like that. I think I would just go the same route as I went with Cloud here and say, if you're using support resistance, you can predefine the area at which you will begin to manage the trade. Hint, hint, is typically just going to be underneath the support zone if you're buying at support. And you can set an alert there, a pending hedge order, a stop loss. You can do a number of things to manage a trade if it goes against you. However, this has to be pre-planned. The two things that matter is what is the distance from your entry down to that area that you will then manage the trade at. It's called invalidation. Essentially the same area where a lot of people would put a stop loss. I just call it an invalidation zone because it invalidates the trading idea, and it means that you have to jump in and step in and do something and manage the position. So you have to figure out that distance in pips from your entry to your invalidation, and you also have to select your lot sizing appropriately. How much do you want to risk if price moves from your entry to that invalidation? $100, $500, $1,000, $5,000, like me sometimes. It all depends. You have to figure that out and you have to decide so that way you can select an appropriate lot size. A lot of this stuff can be managed in the pre-planning of the trade and the trade management structure for what you will do if you are wrong, and the risk structure. So will you be using hedging or stop losses, etc. So let me know if that helps you guys. Just respond here in the Ask Nick Anything chat here, and then I will help you guys answer any questions that you need. So that's that. Cheers, everyone.